The markets are bracing for a massive amount of selling pressure on the open. This, of course, is in reaction to the announcements of new tariffs earlier today. Warren Buffett once said the light on Wall Street can at any time go from green to red without pausing at yellow. Seems that just recently we're talking about the AI space, Nvidia earnings, and the S&P 500 all-time highs. Well, now Goldman Sachs raises the odds of a U.S. recession to 35%. That's from the prior 20% estimate. We're going to talk more about this in just a moment. So the real question is, how much will stocks go down? Of course, we really can't tell, but there are certain tools we can use to estimate the degree of selling. Probably the best is the VIX, the CBOE Volatility Index. It measures the expectation for volatility over the next 30 days. It's also known as the fear gauge. Now, in blue, S&P 500; in red, the VIX, and it tends to move in opposite directions to the stock market. It basically measures a premium on the near-term options in the S&P 500. So when stocks go down, traders buy more options, and the VIX goes up. Well, taking a look at the VIX option futures right now, the S&P 500 VIX futures show us around 23. Well, what does that mean? We took an average over the past 30 plus years of data. We wanted to know, what is the average VIX level per month over the past 30 years. As we enter the month of April, the average VIX level is around 18.9. Now, given indications of 23, we're certainly above the average, not to a tremendous extent, but if we subscribe to the notion of regression to the mean, we would expect that the VIX eventually would come back down. And notice, by the way, not only April, but May, June, July, we actually see the lowest average VIX months of the entire year. This is usually representative of strong stock markets. Now, take a look at the numbers below on the x-axis, the 1 to 366. That represents every single day of the year. And again, this is 30 years of data. So what we want to do is determine, what is the average VIX every day of the year, January 1st through December 31st. And on average, we can see on March 18th, we tend to see, again, on average, the highest highs for the first quarter. That sells off to a July 4th low. Now, of course, the markets aren't open on July 4th, but this is the way the math works out. We tend to see the lowest VIX levels on July 4th. Now, low VIX means strong stock markets, complacent, strong trends. Then the stock market continues to go down, or begins to go down from the July 4th highs. The VIX rises, ultimately hitting highs of October 6th. We recognize October as a very treacherous month, known for big stock market crashes. The VIX then declines as stocks rise, peaking around November 23rd. As of tomorrow, April 3rd, we'll be looking at an average VIX around 21, which is a little bit below where the futures are indicating right now. But notice we're coming off the peak. Now, again, these are averages, and it's not at all meant to predict what's going to happen tomorrow. But the odds are that we're not going to see an extended bear market sell-off starting tomorrow. Now, let's also consider long-term market cycles. This is actually really interesting. So we want to take a look at the average VIX per year, and this takes about 30 years of data going back to 1990, 91 or so. And every histogram bar shows us the average VIX per year. What's really interesting are the gaps in between the spikes in the VIX. For example, we had an economic slowdown in the early 90s, and we had then a strong stock market in the early to mid 90s. The VIX, relatively speaking, was very low, especially look at 1995, right around 12. We had a 7-year gap between VIX spikes. Now, VIX spike, we can define it loosely because sometimes that means 25 and sometimes it means 45. But point being, we had 7 years of complacency. Then we had the 2001 tech bubble. Then we had about 6 years of complacency meaning strong stock markets, that led to the financial crisis. We then had an 11-year span until the COVID crisis in 2020. Now, since then, we've had about 5 years of declining VIX prices, the 5 years of rising stock markets, although not so easy all the time, but rising stock markets. So where does that put us? We're only, if you subscribe to the idea of historical cycles, we're probably 1 or 2 years out from expecting another massive VIX spike. A VIX spike we would tend to equate with 30 or 40. Again, these are averages. So when you see the 2008 or the 2020 levels, the VIX at the peak was actually much higher. But bear markets are indicated by these VIX spikes. So it doesn't look like we're due for one, at least for the next couple years. But what do the tariffs mean for the economy? Well, Goldman Sachs released quite an in-depth analysis, and in part they said economists now expect the Federal Reserve will cut interest rates 3 times this year as tariffs weigh on economic growth and drive up unemployment. They further said that they see the Fed cutting in July, September, and November versus earlier that they had two bets or bets for 2 cuts this year and one in 2026. Now they're expecting 3. Now we talk about the Fed funds futures. We talk about the June meeting so far, at least as of today. There was not the expectation they would cut in June. We're going to revisit the Fed funds futures tomorrow after whatever type of markets we encounter to see how much that's changed. Goldman Sachs also said those higher levies will drive up consumer prices. Goldman now sees year-end 2025 core PCE expenditures of 3.5%, which is certainly quite a bit higher than where we are now. They finally said they also lowered their 2025 gross domestic product growth forecast by 0.5 percentage point to 1% in the fourth quarter. So they're really kind of mimicking what the Fed had said, Jerome Powell had said during the last Fed meeting. They're raising their inflation expectations, lowering their growth forecast. Now, the Treasury market is bearish. Here in red, that's the 10-year U.S. Treasury bond. In blue, that's the 1 year. The gray area chart is the spread between the two. You may recall we were talking about this a lot about a year ago when we had an inverted bond market where the 1 was ahead of the 10 or above the 10. That's not the case here. But there is something we should make note of. Now, quick reminder, when we talk about long-term bonds like the 10-year, that reflects the expectation of long-term economic growth. When we see a strong economy, 10-year bonds tend to rally. The short-term bond, like the 1 year, that is more reflective of future Fed decisions. If the Federal Reserve decides to cut rates soon, or the market thinks that it will, then we'll see that 1-year bond yield, we're talking about yield here, go down. Notice what's happened since that sell-off we saw beginning in February. The big Tesla and Mag 7 sell-off, among other stocks, of course. The spread between the two is narrowing. What does that mean? It means that while the Federal Reserve is not expected to cut rates any sooner, at least as of right now, growth prospects are declining. Now, eventually what's going to happen? The Fed's going to say, okay, things have gotten bad enough and that now we have to lower rates. And when that moment occurs, we'll see the blue line, the 1-year bond, travel lower. That's not happened yet. What may trigger this? Friday. Be very wary because right now this tariff news, this is the big news of the day. We have non-farm payrolls on Fridays. The ADP number was okay. The JOLTS was not good. The Fed layoffs were not factored into last month's non-farm payroll. So be wary, that could be quite the bleak number. Speaking of numbers, on the economic calendar, S&P final U.S. services PMI and ISM services on Thursday, and of course the unemployment rate and non-farm payroll on Friday. So please be very wary of that. But again, historically speaking, this is usually not the season for extended bear markets. Of course, every market is different. We'll be back shortly with an update on everything that we've discussed and more. We hope this has been helpful. We look forward to seeing you back soon.